Good evening, traders. Today is Tuesday, April 11th. Tomorrow we have CPI. That's really what it boils down to. Today was a means to an end. We're going to start backwards and then go back to intraday trading. What you're looking at on the screen right now is SPY. Extended hours tonight. What was this big red candle all about? I don't know. But what I do know is this tweet that I'm showing you right here with 1 minute to go. This is Central Time. 1 minute to go before closing bell. I got puts. I got puts on that leg down. I'm going to tell you why I got puts in just a moment. I do think, let's see if I'm correct. I do think CPI is going to bring the markets down tomorrow. I'm going to show you my reasons for that. This is futures 5 minute as of like 5 minutes ago. Lower highs, unable to take back the EMA 50 on the 5 minute chart. Lower lows, and the MACD is unable to pierce the zero line once. Couldn't even do it. Couldn't do it. They're keeping it down there on purpose. You want to know why? Now keep in mind, they haven't been doing this the last 2 weeks. You want to know why they're doing this? Forcing futures to stay below the EMA 50 line, making lower highs and lower lows, and forcing it to stay below the MACD line. It's because of this 1 hour chart. You're going to see me tweet about that in a few moments as well. At closing bell today, this big red candle, that forced a negative crossover. It forced a negative cross from the signal line right here. That is exceptionally difficult to overcome. In other words, go from a negative cross back to a positive cross while staying above the zero line. That is exceptionally difficult. So, as soon as I saw that negative cross confirmed, I got puts. And as I've said in previous episodes, you always have a 90% retracement from your starting point to your ending point. So I predict the 1 hour MACD on futures, and the same goes for SPY too. It's not just futures. It's going to end up somewhere down here. It's currently right there. It's going to end up somewhere down here. What do you think can force that to happen? I think it's CPI. I think it's CPI. Because, let's look at history. What happened last time you had a negative cross? You didn't get back to a positive cross, did you? Because, like I said, it is exceptionally difficult to do that. And this is an example of that. I saw this same pattern here. As I saw right here, I said, uh-oh. Time to get puts. And what happened? Boom. When you have a negative cross, it is very difficult. Okay, so that's what I think is going to happen. I've seen this pattern many times in the past 4 months since January. Okay? So I'm not just cherry picking my patterns. I've seen this. You can consider me the historian of the MACD, especially the 1 hour, the 65 minute, well, the 5 minute, obviously. All right? You can consider me the historian. When I see patterns like this, because I'm looking for this stuff, you'll see that in my tweets as well. I'm looking for this kind of stuff all day. I'm waiting. You'll see me tweet about it as well. Now, okay, let me show you an example of consolidation under the SMA 20 right here. See that? So, came down, bounced off, came up, pushed up, and basically took it. Okay, this is considered consolidation. You have a green candle, wick up, right? That's consolidation. So down, up, up, up. You took back the SMA 20. What do we have tonight? Wick down, wick down, wick down, wick down, wick down. This is the SMA 20, the same SMA 20 as right here. This is the EMA 50. This is the 1 hour. And the 60-minute, the 1 hour MACD is negative, has negative cross and fading down to the zero line. Okay, so yep, we shall see. This is not a bullish setup. That's what I'm trying to tell you, right? Because the last time it looked like this, it went like that. Okay, this yesterday, all of this. This is the hourly chart, guys. 1, 2, 3, 4, 5, 6, 7, 8, 9 straight positive candles. 9 consecutive hourly positive candles. You know what I call that? That's an impulsive move. And what have I said in previous episodes? When it is impulsive, it always gives it back the following day. This is an impulsive move. Okay, so if it surges tomorrow on CPI, then that actually goes against history. As you're looking at right now on the screen, I'm showing you data. I'm showing you history. I can show you many other examples, but I'm just showing you one right here. If it surges tomorrow, it's going against history. Okay, so let's get into intraday. Intraday. Pretty much at 8:30 a.m. Central Time, right at opening bell. I just said, I'm gonna watch for a few candles, but this may just go up from opening bell. I was already calling for it to go up, guys. You want to know what made me say that? It's not on your screen, but I already said it right at opening bell at 8:30 a.m. This may just go up. And it did. It went down first. Yes, it did. It went down first, but it went up. Okay? Why did I say that? The exact same 65-minute chart that told me at the end of the day that this is going lower is the same 65-minute chart that made me say this may go up from opening bell. Okay, so I'm using the exact same 65-minute chart to tell me, today's going to be an up day. But that same chart at the end of the day said, uh-oh, I think we're going lower. Okay, so I'm being actually objective here. I'm not just cherry picking my data. All right, so right here. Yeah, it was this candle right here. See, I'm already scaling long. Primarily because I saw wick up, wick up, wick up. Now, this was the challenge this morning, this whole down move right here. What you can't really ever know is where does the higher low notch, see, starts down here, comes up. Does it stop here? See, it started to curl up. Oh, does it stop here? Oh, no, third time it stopped here. Okay, so that's basically what I was looking at this morning. When I started scaling along, I was like, oh yeah, I got in right there. Okay, oops, well, scaling more long. And when I saw that go down right here, yeah, right here, I scaled more. Okay, because I'm like, nah, the bottom somewhere around here. It's not going that much. It's not going that much lower. That was my point of scaling long again. Like the bottom somewhere around here. Okay, so okay, here we go. It was right. 1, 2, 3, 4. 1, 2, 3, 4. Oh, this one was red at the time, but it turned green. Wicked up and turned green right here. This green candle is equivalent to this red one at the time. So notice I said I have not bought puts because it's at the 65-minute SMA 20 support. It's not shown on the screen, but it was when I was looking. Okay, when it's at support like that, plus when I saw this still making a higher low notch, I said, no, I'm not buying puts. Because what do I say in the very next tweet? Oh, well, oh yeah, here it is. Here's the 65-minute SMA 20. I do have it here, right there, right here. See that? As you guys know, I look at the 5-minute and 65-minute simultaneously on the screen. That's how I knew. I was like, oh, well, you're finding support on SMA 20 and you don't even bother touching the EMA 50 on the 65-minute. That's bullish. Okay, it found support on the SMA 20. Gray line right there. 409.13 right here. Okay. This candle is basically like equivalent to this one right here. But on the 65-minute. Right here. I called it. Bottom's in, guys. Bullish divergence. That is okay, this is lower than that. That is higher than that. Called it, guys. That's the bottom. Right there. And was I right? You bet I was. Scaling more. Scaling more. Let's go. Let's roll. Let's roll with it. So I was scaling longs all morning. Okay. So as it came up here, that would have been like right here. Yeah, right here at the time. In 10 minutes, a new 65-minute candle opens. It's backtesting the EMA 50 at the moment. Yes, it was. So 10 minutes, 5, 10. Okay, yeah. 5, 10. Here's the new candle. Here's the new 65-minute candle. What happened? Consolidation under the channel. As I've pointed out in the past, that's how market maker always does it. I really have yet to see a bounce off on top of the channel and then up. It's just been time and time again below the EMA 50, finding support SMA 20, come up again. Time and time and time and time and time and time again. I can't remember the last time it bounced off of EMA 50 without going under it. I cannot remember the last time. And since I'm the encyclopedia for the EMA 50, that says something. Okay? So, there you have it, guys. Okay. Once again, I'm comparing this high to this high to this high. Higher highs. We're going up. Still not too late to get calls, but the window is closing. Not too late. Not too late. Okay. Right here is equivalent to right here. Okay, in 6 minutes, a new 65-minute candle opens. Watching this closely. What happens when the new 65-minute candle opens? Up we go. Right here. Boop, 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 boop. Look at me, I'll counting again. Once again. Okay. In 10 minutes, a new 65-minute candle opens. I just keep referencing. That would have been this tweet right here. Yeah, right there. I'm looking closely at the blue channel. It's pushing off of the blue channel, getting lift. See that? See this right here? It's clear. You're getting a lift. It's been riding up the SMA 20 all afternoon. It's been riding along the SMA 20 all afternoon right here. See that? right here. But right here, now it's lifting off of the blue channel and SMA 20, but you're getting lift. Now you're not even touching the channel. Now you're not even touching it. So see, that's bullish. Okay. Okay, oh, I don't have the green line, but I have it right here, 410.85. That would have been 410.90. That would have been like, yeah, see, you can see it right there. Going right up to the line and not crossing it. 410.85 is equivalent to this pre-market high right here. Right here. Okay, that's 410.85. You eclipse that line, you're going higher. That's just the way it is. Just like this is higher than that is higher than that. Okay? Okay, now. Haha. Now I start to warn you guys. Be observant of possible bearish divergence now. But the bearish divergence could be negated if the MACD curls up. So, check this out. That would have been right here. Right here. Yes. So that's obviously a higher highs right here. That's higher highs. But this is not. This is not. It was it's very slight, but it's there. Okay? This is the 5-minute chart. So higher highs, you're not getting higher highs here. Very slight bearish divergence, but it was there. Cuz I'm watching for this stuff. Okay. Now okay, let's check this out. Oh, well, yeah, this is me saying, oh, well, if it gets to that red channel 411.30 right up here, all the way up here, obviously it didn't get there. That's it for me, guys. Once it touches the red channel, I'm scaling out of calls. Obviously, we know now it never got there. When I saw this, though, right here, I was like, ooh, we haven't seen that like all afternoon. This red candle right here, right there. I said, I'm out. I'm out. Scaling out. MACD's curling down. Let's go look straight down. MACD's curling down. Yes, it is. Okay, you guys, I want to call your at the beginning of the episode, I told you, when you have a negative cross, it's very difficult to overcome. And I was talking about the 65-minute at the beginning of the episode. And now I'm talking about the 5-minute here. You're looking at the 5-minute here. What happened when you have a negative cross? It stayed negative, did it not? And then it collapsed. That's what I'm saying, guys. This is the 5-minute. I showed you at the beginning the 65-minute. The 65-minute is even harder to overcome. If it's hard to overcome on the 5-minute, just think about how much momentum you must have to overcome on the 65-minute. It's tough. It's tough. It's damn near almost impossible. Okay? So, in this example, you're looking at the 5-minute. Earlier, I showed you the 65-minute. That's why I said history is not on your side if it surges tomorrow, because we have a you have a negative cross confirmed. That's why I got puts. As soon as I saw the negative cross on the 1 hour, I wasn't looking at the 5-minute here. I got puts on the 1 hour. I got puts, I can't remember, right around here, something like that. As soon as because I was waiting for the red candle, I was like, no, I need to see negative cross on the 1 hour, not on the 5-minute, because the 5-minute is already negative cross like way up here. As soon as I saw it on the 1 hour, got puts. Okay. So, here we go. I hope you guys got out. Bearish divergence is playing out. You have been warned. Okay, let this be a proof positive example. The MACD is not a lagging indicator. I called bearish divergence before the collapse, and I called bullish divergence as the bottom. So I called it both ways today, guys. I called the bottom, and I called the top before it happened. Okay? So, I'm considering getting. Oh, this is earlier. This is before. I'm just showing you. Yeah, see, what I should. Yeah, I said I got puts like right around here. Here's a screenshot of before I got puts. I'm considering getting puts, holding on to tomorrow for CPI. I see bearish divergence on the 65-minute. Here you go. I'll explain more in a little bit. It's related to the 65-minute. I've watched it all day. So, and I am playing a small put hand. I'm not going full bore, load the boat with puts. It's not that. Okay? This is my thesis. Negative cross is a prelude to the CPI print. And I'm talking about here we go, the 65-minute. Here, check it out. Yeah, you can see it. See, there's the green line kind of faded. There's the negative cross on the 65-minute, guys. There it is. Okay? It's a prelude to CPI print. All drops are preceded by a negative cross right here on the 65-minute and bearish divergence on the 65-minute. Bearish divergence down, price goes up, MACD goes down. This is 65-minute, guys. This doesn't just reverse quickly. Oh no. Okay, so examples: March 7th, 22nd, April 4th, and today. You have a negative cross and you have bearish divergence on all of these days, including today. As you know, I always watch the 65-minute all day. All day, the 65-minute did not negative cross. That is until the final 15 minutes. Negative cross is extremely difficult to overcome. To be a positive cross, it is exceptionally difficult. Exceptionally difficult. As you see, this was the 5-minute. It's exponentially easier to go from a negative cross to a positive cross on the 5-minute, like this. Negative, positive, right? It could be done pretty fast on the 5-minute, right? But even at the end of the day, it couldn't do it. It ran out of gas. It couldn't go from a negative back to positive. It went from negative and then collapsed. Okay? So, that's what I'm saying. Now, I need to call this out to you guys. This is important. There is a 70% correlation between M2 money supply and CPI. In other words, M2 money supply is also known as, for you guys who like to look on the Fred website, Fred total assets. What are total assets? Treasury bonds and mortgage-backed securities. It's that $9 trillion that I've talked about in previous episodes. Oh yes, there is a 70% correlation because look, the blue line is total assets. The red line is CPI. Oh yes, 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 yes. Now, not only is there a 70% correlation between M2 money supply and CPI, the only reason why CPI has been going down is because, see right here, this has been going down. This is the M2, this is the Fed mortgage-backed securities and treasury bonds. It has been going down. That's why CPI has been going down also. It has nothing to do with the interest rates. Now, but what happened last month? It was going down because they were doing monthly drawdowns, but it surged back up. Another 300 billion. What was that for? That was for the Silicon Valley Bank and the Credit Suisse and all these failing banks. They re-injected 300 billion in. So they went from 9 trillion down to 8.4 trillion. Add 300 billion. Now you're back up to 8.7 trillion. So now you're back up to 8.7 trillion out of 9 trillion. And guess what? If you're back up, if you went down, now you went back up by 300 billion, and there's a 70% correlation between the M2 money supply. Guess what? CPI is going up 2. There you have it. That's why I also suspect, not expect, I suspect tomorrow's CPI print's going to come in hotter than what people think. And it's because the Fed reinjected $300 billion into the total assets, the M2 money supply. That's why I think CPI is going to come in hot. When you combine that with 65-minute MACD negative cross, and it's going to typically retrace 90% back to its original starting point, I think things are aligning to go down tomorrow. And this is the data that substantiates what I'm saying. It's not just my opinion, okay? So, I've been wondering all day how Market Maker would position itself for CPI tomorrow. The drop in the final 25 minutes answered my question right here. The 65-minute MACD is deceptively powerful. It's how I knew this morning that today would be an up day. But on the flip side, it's also how I can tell that tomorrow is going to be a down day. 65-minute also foretells a fall, not just an up move. It also foretells a fall. Okay? So, could I be wrong? Sure. I could be. But I'm going off history, guys. And I just gave you examples, several examples, where I think I'm going to be right. But I could be wrong. That's fine. I didn't play that big of a shorthand anyways. As I showed you in that tweet. I said, well, I'll just put a little bit. I'm not going to lose any sleep if I lose that. So, consider this more an exercise, an intellectual exercise, based on history, if I am right. Okay? Feel free to follow me on Twitter, as I give real-time tweets like I did today, calling the action real-time. Don't forget to listen to your favorite music as you are trading. And not trading, please listen to music. Please give this video a like, share, subscribe, or click to be notified when I release something new. With that, I'm Agent 00 Woe, signing off.